Quantitative finance. Yeah, I know. It sounds super complex, maybe even a little scary. But what if I told you it all boils down to one thing? It's about making smart choices when you have absolutely no idea what's coming next. So let's pull back the curtain and demystify the world of the quants.
Okay, picture this. You're on a boat, caught in a massive storm. The waves are just insane. The wind is howling. Now, would you rely just on your gut feeling to get through? Probably not, right? That could be a total disaster. Well, the financial markets, they're pretty much exactly like that storm. Completely chaotic, uncertain, and always changing.
So how in the world do you navigate all that chaos? Well, that's the big question, isn't it? And it's the exact problem that quantitative finance was created to tackle.
Look, your intuition is important, for sure. But quantitative finance, that's your detailed map, your high-tech GPS, all your advanced navigation gear. It's about getting past just having a hunch and actually charting a course based on solid information.
But before we dive into the quant's toolkit, we've got to bust some myths. Because, to really get what this field is, we have to be super clear on what it isn't. All right, first myth up. The whole black box thing. The idea that it's this super secret, complicated thing nobody could understand. And yeah, the math can get pretty hairy, I'm not gonna lie. But the reality is, the whole field is moving towards being way more transparent. They want investors to actually get the logic driving these models.
Okay, myth number 2, that these models are basically crystal balls, that they can predict the future perfectly and never, ever get it wrong. This is a huge one, folks. But the truth? No model is perfect, not even close. They're incredibly powerful tools, for sure, but they have serious limits. I mean, just look at the spectacular collapse of long-term capital management back in '98. That place was run by Nobel Prize winners using the most sophisticated models you can imagine, and it still blew up. That tells you everything you need to know.
And that brings us perfectly to myth number 3, that quant and their algorithms are here to make humans totally obsolete. Nope, not happening. Human judgment is still absolutely critical. Think about it. A model can't really understand a sudden political crisis or get a feel for the raw fear and greed that can just take over a market. That's where you need a human.
So now that we've busted those myths, the picture starts to get a lot clearer, right? I think author Matt Davison really nails it. He says it's not just about cold hard math, it's the art and the science of making the best possible calls when you just don't know what tomorrow holds.
All right, so if these quants are our navigators in the storm, what kind of tools are they actually using? Let's pop open that toolkit and look at 3 core ideas they use to bring some order to all that financial chaos.
So it really breaks down into 3 main things. First, they build models to map out what the future might look like. Second, they get a handle on risk, what it is and how to manage it. And third, they use all that stuff to find a competitive advantage, what traders call an edge.
Let's kick things off with modeling. A great, simple example is something called the binomial tree. It sounds fancy, but the idea is actually pretty straightforward. It's a way of taking a super complex future and just breaking it down into simple, branching paths, like a choose-your-own-adventure book. At every single step, a stock's price can do one of 2 things, go up or go down. That's it. By mapping out all these different paths, you can start to figure out the chances of different things happening. It's a brilliant way quants take this big, scary uncertainty and turn it into a map you can actually read.
Okay, next up, managing risk. And this is key. You have to understand that not all risk is created equal. Quants are really big on splitting risk into 2 buckets. First, you've got systematic risk. This is the big stuff that hits the entire market, like a recession. There's nowhere to hide from it. Then, you've got idiosyncratic risk. This is stuff that's unique to just one company, say a product recall or a factory fire. The cool part is, you can't do much about a recession, but you can do something about that company's specific risk by, not putting all your eggs in one basket. Quants spend their time building models to measure and deal with both kinds. And last but not least, we've got seeking that edge. This is where all those fancy models and risk calculations get put to work at mind-blowing speeds. We're talking about algorithmic trading, high-frequency trading. These are systems that use powerful computers to make trades in a literal fraction of a second. They're designed to find and exploit tiny, blink-and-you'll-miss-it pricing errors in the market that no human could ever hope to catch.
So, okay, we've got these amazing tools, right? Sophisticated models, risk metrics, lightning-fast algorithms. It sounds like a perfect, unbeatable system. But it's not. Not quite, because all of this brings us full circle, right back to the single most important part of the equation.
Let me tell you about a trader named Emily Thompson. She was really successful. relied mostly on her gut, and she kind of looked down on all these quant tools. But then she had this humbling experience, and it completely changed her mind. She realized that these models, things like factor models, they weren't there to replace her intuition. They were there to make it even sharper, to complement her skills and make her an even better trader.
And that really is the key takeaway. You have to remember, these models are tools. They are not magic wands. Think of it like a hammer. In the hands of a master carpenter, it can build something beautiful. In my hands, it's probably going to cause some damage. Their power depends entirely on the skill of the person using them. And that LTCM collapse we talked about, it's the ultimate proof that even the most brilliant models without smart human judgment are just a recipe for disaster.
So where are we headed with all this? Well, it seems to point to a future where the real secret to success, not just in finance, but probably in a ton of other fields too, is going to be this incredible partnership between human insight and powerful machine analysis.
And listen, this isn't just some abstract thing for Wall Street traders to worry about. The core ideas here, making decisions based on data, but also knowing the limits of your tools, that's becoming crucial for everyone, everywhere. This balance, this dance between human brains and machine intelligence, it's shaping our entire world. And figuring out how to navigate it, that's probably one of the most important skills you can have for the future.
Which of course leaves us with one last really fascinating question to think about. As our machines get smarter and our models and algorithms get more and more powerful, what does that mean for us? What's left for human intuition? What is our new, unique role in the world of decision-making?